Hello, dear people. How are you? I hope you are doing fine wherever you are. I am the ACCA tutor, Mr. Jerry Mutumkulu from Zimbabwe. Okay, in this video, I'm going to take you through uh, the questions I found to be very challenging and which you have also said that I should explain on as a way of feedback. Okay, so let us please pay very careful attention to the presentation as I go through because you never know. This could be your chance to pass this examination resoundingly. All right, so without much ado, let us get straight to the business of the day. Now, the objective of this is to offer you, some sort of comfort as you try to prepare yourself towards passing this very important examination, right? So you need to correct your initial positions as well as to add your knowledge on what you know. All right, this video is not going to be useful if you have never, I mean, covered this very crucial syllabus. You need to have at least studied the ACCA management accounting syllabus and then uh, use this video as part of complementary work. Okay, and for those we have done our mock one, our first mock, this is going to be a 95% plus weapon or advantage as you be actually given the exam, the examiner's mindset such that so that you prepare yourself adequately to pass this examination without with no frills or hassles. Okay, so that's all about this. The objective of this video, right? That's the name of the school, ladies and gentlemen. For those who do not know us and want more coaching or want to do business stuff. All right, let me just try to, uh, give you my numbers again. Sometimes you don't know those numbers, or maybe you saw the numbers, but you say that no, there's no point in knowing them. It's very good for you to have those numbers in your wallet or in your phone because one day you might want to chat with me so that I give you further assistance. I do not only teach management accounting but also other ACCA modules. So if you are really serious about passing these examinations, the ACCA examinations, please do not hesitate to contact me any day, anytime. All right. So I'm contactable on plus 263 774 596 368. Okay, so those are my numbers. All right, our motto or slogan is that we hope to innovate, excel, and lead in whatever we do. All right, now, ladies and gentlemen, this is the first question, uh, which I think we need to talk about. What is the probability that an observation for a normally distributed variable will be greater than 1.24 standard deviations above the mean? All right, so ladies and gentlemen, we are going to be tested on normal distribution in this examination. So you are also going to make use of the normal distribution tables, right, or the Z-score tables, right? So you need not to crack your head on what shall I have to use and so forth. But when we are talking of a data that is normally distributed, it usually follows this type of uh, behavior. All right, so this is the normal distribution, a typical normal distribution graph. Okay, and at the center here is what is called the mean, or X bar, right? That's where we get the mean. So it is assumed that the area covered by this graph, okay, this whole area, when added, it comes to 1. Okay, the whole area, if we add that whole area, we are going to arrive at 1. Okay, so it simply means that the mean, this one, this line, right, is demarcating, or is making the information on the left side and the right side equal. Okay, I mean, it's a dividing that information into two halves. Okay, so which means on the left side the area is 0.5, and on the right side the area is 0.5. If we add them up, we come to 1, or 1.0. Are we together, ladies and gentlemen? So knowing that in mind, you will be able now to make use of the Z tables, or the normal distribution tables. All right, so our question is saying that we need to determine the probability, okay, the probability that an observation for a normal distribution variable will be greater than 1.24. All right, so if we come to the tables, these are the normal distribution tables, right? They are actually the standard normal distribution table. All right, so for you to get the probability, you then have to make use of the standard deviations. All right, so if you look at this first column, that's where you get your standard deviations. So we are told that this particular variable is 1.24. So if we come to 1.2, right, then the 4 is found here. So you need to move. Okay, you move along these figures until you get to a figure where these two lines, the vertical and the horizontal line intersect. That's the probability we want. So all the data inside, all these data are probabilities. So the probability that this particular variable, okay, will be greater than 1.24 standard deviations, all right, is all right. So the the probability that this particular observation will be greater than 1.24 standard deviations can now be found. All right, let me just say can now be found. The mistake which we might quickly make is to think that this is now the probability that a particular variable is 1.24 standard deviations above the mean. No, this one simply tells us that at 1.24 standard deviations, the probability is 39.25%, or 0.3925. Right? At, that is, if we are talking of at 1.24 standard deviation. However, the question is saying at 1.2 is, above 1.24 standard deviation. That's the issue. We are looking at above, not at, right, but above. So we are looking at a position which is greater than 1.24 standard deviation. So let us come back, let us get back to our initial drawing. All right, let us get back to our initial drawing. So let me try to erase one or two things here. All right, so let me again draw this. This is the same table we are talking about. And remember, I said both are 0.5, 0.5. Okay, so this is minus 5, then that one is plus 5, whatever the case, all right? So this is minus 5 below the mean. This is 0.5 above the mean, all right? And I said the mean is the center line, the X bar. All right. Okay, now the question talks of a point of 1.24, all right? Greater than 1.24 standard deviations above the mean, right? But let us suppose this 1.24 is a point that is here, okay, 1.24. So it simply means that an area which is between the mean X bar and above a point that is at 1.24, that area should be this particular area, okay? Because if we are saying 1.24 above 1.24 standard deviations above the mean, so it means that we are looking at this particular direction, okay? So everything that is here, all right, is going to be shaded, all right? Now, what about now a point that is this point which I have shaded, all right, this point up to here, up to 1.24, has got a probability of 0.3925 according to our tables, right? That's the point, all right? Now, we then want the probability that an observation will be greater than 1.24. So this should be an area which is somewhere here, okay? Because greater than, we are looking at, remember I said below the X on your left is a negative, but here is a positive. So if you're looking at a point greater than 1.24 standard deviation, we are looking toward the right side of that graph. All right, but remember, initially I said that the mean dissects this graph into two. On the left side, the total area on the left side is 0.5. On the right side, the total area is 0.5. If we add them up, we should come to 1 or 100%. So what it simply means is that if we know that between X bar and 1.24, the probability is 0.395, and also that the total area between the mean and the right side of the graph is 0.5. Therefore, to get the probability of the observation which is greater than 1.24 standard deviation, this should be 0.5 minus 0.395 Sorry, my recorder just reached the maximum recording time and it cut. All right, so the probability that this particular observation will be greater than 1.24 then becomes 0.5 minus 0.3925, and we should get something like 0.10. Let me check here. I don't have a calculator. All right, so it should actually be this one, 0.1075. Please just pause this particular part of the video and you read whatever I was saying is actually presented in these notes. So your probability then becomes 1.0 0.1075, and this can be rounded up to this should come to this, that is if it is to the nearest two decimal places, right? And how do you know that you were supposed to go to two decimal places? The examiner has explicitly said so, right? You need to round up to two decimal places, and if you look at the choices given, they were to two decimal places, so you need to lead yourself. Are we together? Thank you. So let us try another question that talks of the normal distribution curve. All right, let me just try to erase this data. Good. Now, question number 2. Consider the following statements about the normal distribution. Number 1. The total area under the standard normal distribution curve is 1. 2. In any normal distribution, the mean and the median are the same. Are each of the statements true or false? Well, there is a tip. When working with normal distributions, remember that the mean, median, and mode are equal due to the distribution's symmetry. This property can be helpful in various statistical computations and analysis. So you need to bear in mind that if you are talking of normal distribution or data that is normally distributed, then it means that the mean, the mode, the median, they are all the same. So this one, statement number 2, has been proven to be correct. What about statement number 1? The total area under the standard normal distribution curve is 1. So you can as well see that we have been discussing about this, that whatever the area, this particular area, if we add it up, it is going to give us a 1. Okay? Remember I said that the mean, the x bar, is dividing this into 2 halves of 0.5, 0.5. If we add them up, we come to 1. Okay? That's the assumption of normal distribution. Okay? Okay. Somebody might be worried and say, but what are we talking about if we are talking or if we are referring to normal distribution or normally distributed data? What are we talking about? All right, normally distributed data has got the attributes of being largely concentrated around the mean. Okay, so it is that data which most of it is centrally near to the mean. For example, if you are looking at the height of men, usually this one is on average 1.75 meters. So if we take a group of men, let's say 100 men at a rally, Okay, you guys, I know you like rallies. Okay, so if we take a group of men at a rally, whatever party, we don't care. Now, if we take them, about 100 of them, they normally range in terms of height around 1.75 meters. At least Zimbabweans, they are that tall. All right. So with a few that are 1.9 meters, but they might be very rare. But the majority center around 1.75. So with a few taller or shorter, but most of them, their height is centrally there. So that's a normal distribution. All right. Another example is if we are talking of exam scores. Exam scores. A lot of students perform uh, relatively the same. So on average, they just come up with almost similar grades. So you can see that the mean is the largest number there. Why? Because students usually have got similar potential, right? They usually have similar, they share some similar attributes when it comes to passing examinations. Well, I'm not saying that you relax because a lot of guys they out there are so not, giving much effort. No, in as much as you put more effort, your exam score is largely going to be the same with others. That's what I'm trying to say. Okay, but we are encouraged to put more effort. All right, because there are also outliers. There are some people who are going to come up with 99% or 100%. They totalize. All those things happen, but the majority will be around a certain average. All right, so I'm sure I've given a background or maybe some additional information about what a normally distributed data is. Now, so we have discovered that both statements were actually true. All right, that's the explanation, which might as well edify what I have been trying to say. So you can pause the video and read whatever data that is there. But as for me, we don't have that time. Question 3. Horizon Travel Company offers bespoke adventure packages to travel enthusiasts. Each package includes a week-long stay in premium accommodations and access to exclusive excursions. The company books and pays for 50 adventure spots per week at a cost of $120 per spot. Each package sold generates a contribution before deducting the cost of the spot of $300. The forecast weekly demand for the packages is shown in the table below. So that's the forecast weekly demand. What would be the expected profit per week? So you pause the video, you do the computations on your own. Okay, I'm sure by now we have all covered what are called expected values. Okay, these ones are average returns or average results we expect to obtain because of the uncertainty related to a cash flow. All right, so we are required to compute the expected profit. Okay, so if you know the concept of expected values, all right, so you can just remove the word value and say expected profit, but it will be just doing the same thing. Okay, expected profit. We'll be using probabilities, right? The demand and the expected occurrence of that demand. All right, so for example here, the demand for packages, normally sometimes it's 200, 200 units or 200 packages required or that can be sold in a week, we can sell 200, these bespoke adventure packages, we can sell 200 in a week. But the probability of selling 200 is just 10%. So obviously, the amount of packages we are going to sell at 200 is just 200 multiplied by the corresponding probability, and maybe we will arrive at 20 packages. So we are going to sell 20 packages. And then here, if we are saying that we are forecasting to sell 300, there is a probability of maybe 25%. So 300 multiplied by 25%, this should be how much? Okay, let me just use my calculator here. 300 multiplied by 25, that's 75 packages. Then what about here? If we are saying, no, there is a demand for 400 and there is a 30% chance that we can sell, so we are looking at 120, right? And what about 500? Okay, 500 with a chance of 35. 500 multiplied by 35, we are looking at 175. Okay, so these are still packages, not yet the profit. These are just packages, right? But we are told that we can sell these at $300, but before deducting any cost related to, those spots. So this is just the contribution. So contribution, we know that contribution is equal to selling price minus variable cost. However, contribution is just contribution towards covering fixed costs. So we need then to deduct the fixed cost to arrive at the profit, right? So the fixed cost we are talking about is given here. So we need to then, after we compute the total contribution, let us find the total contribution. We are told that this the cost, the contribution is $300. So let us multiply $300 in all these figures by 300. So 300 by 300. So what figures do we get, guys? Let us be quick. Let's start with the first one. I think 300. That's 0, 0, 0. 300 multiplied by 20, obviously. It should be, let me confirm. I think it's 6,000. Yes. What about 75? Multiplied by 300. That's 25,000. Sorry, it's 22,500. What about 120? 120 multiplied by 300. That's 36,000 net. And 175 multiplied by 300. That's 52,500. So let's get the total contribution. The total contribution, this should be 52,500 plus 36,000 plus 22,500 plus 6,000. We get 117,000. All right, that's the total contribution. But we then need to deduct. We need to deduct this animal. Remember, I said that we then need to factor in the fixed cost. 50 adventures at a cost, 50 adventure spots per week at a cost of 120. That one is fixed cost. All right, we need to cover for it every week. So that's 50 multiplied by 120. How much do we get? Okay, I'm seeing that we get uh, okay 6,000. Okay, so this should give us a profit of, so the profit should be 111,000. Okay, because this one has to be deducted. So 111,000. So if we look at our answers, we do not get that figure. Okay, and I am sorry for that. That was an oversight on my part, and the main problem could be linked to these other figures. Okay, they are inflated. All right, actually, the demand should be 200, yes, and then 30. Think 40, 50. All right. Uh, I'll verify, all right, verify again on the figures, but uh, that shouldn't be a worry for now. What I want you to grasp is the concept, all right? Remember, uh, some of these questions we modify the original exam questions for the purpose of learning because we simply just check the real question which was used. Those questions will be available online and you won't learn properly because you know the problem with uh, information at your fingertips. You end up try to shortchange yourself, ending up cheating and so forth, referring to those questions and so. So I'm sorry for that. Next time I'll first of all, try to uh, ensure that my figures are going to correspond. Right, I take that responsibility. All right. Try to use the figures which I have then inserted for the demand and determine if you're going to arrive at the same computation. And you need to get D as your answer. If you use these figures, you must obtain your correct answer as D, right? You need to come to that, right? So that I think corresponds with this, as you can see, the demand after, um, sorry, here, it should be 20, not 200, right? It should be 20, 30, 40, 50, right? So I worked with these other figures. These ones, they are not going to take us to the dreamland. So if you use the other figures which I have written, you must come to this type of computation and your answer should be 5,700. I'm sorry for that. So it could be a typo when I was typing the figures. Right, but like I said, let me just re-emphasize that what is important is just you need to gather the main points that are going to save you in the upcoming examination. Now let's talk about this question. The standard fixed production overhead absorption rate in a factory is $20 per machine hour. 1,760 machine hours worked in a period during which the fixed production overhead variances included capacity 3,600 favorable, volume 2,400 adverse. What were the budgeted machine hours? Now, when dealing with variance analysis, remember to consider the direction of the variance, favorable or adverse, and its impact on the budgeted and actual values. In this case, the favorable capacity variance indicated that the actual machine hours worked were more than the budgeted. So in terms of capacity, we worked, I mean, the machine hours which we worked were more than the budget, which is a favorable thing. Okay, talks of our capacity utilization. right? But when it comes to the volume, this one was adverse. Are we going to be happy when it comes to volume? Volume seems like it's linked to the output. In as much as we worked many hours, but the output is adverse, we are not going to be happy with that. Okay, but it seems like we are going somewhere. All right, so what were the budgeted machine hours? Obviously, for you to be able to do or to answer this question, you then need to be good at the, you know, the to show your acumen when it comes to formulas, because these are things that are linked to formulae, and you need to then tell the examiner that I am up to scratch in that regard. So let's talk of fixed overhead variances. The fixed overhead capacity variance is the difference between the actual hours worked and budgeted hours. So the actual hours which were worked vis-a-vis the budgeted hours multiplied by the standard fixed overhead absorption rate. The fixed overhead volume variance is the difference between standard hours required for the actual production. This is why I say that volume is linked to the output, right? So it's the difference between the standard hours required for actual production and the budgeted hours multiplied by the standard fixed overhead absorption rate. Given information, actual hours worked were 1,760 hours. According to the question, we are told that these were the hours which were worked. So those were the actual hours worked. Standard fixed overhead absorption rate, we are told that this was $20 per hour. Fixed overhead capacity variance, this is 3,600 favorable, indicating that the actual machine hours worked were more than budgeted. So we liked that. All right. Now, how do we calculate the capacity variance formula? All right. So capacity variance or fixed overhead capacity variance is equal to actual hours minus budgeted hours multiplied by the standard fixed overhead absorption rate, which is equal to the capacity variance. So if we substitute values into this formula, we are going to come up with the 1,760, which was the actual hours according to our first assessment there, minus the budgeted hours. Remember, the budgeted hours is the figure which we need, because the question is saying that determine the budgeted machine hours, right? So, like I said, you need to know the formula before you try anything. And my general assessment is that you guys were having trouble in terms of variance analysis, and you need to revisit that area before you then attempt your second and final mock. All right? You need to revisit variances. Revisit variances. So now, if you know the formula, you can simply attack these questions with ease. All right? So we have inputs 1,760 hours minus the budgeted hours, okay, which is the subject we want to determine, right? Want to find that. Multiply by $20 and we get our 3,600. Remember, this was a favorable variance or the favorable amount, and we need because the direction, remember, the direction of the variance will tell you if it is a negative or a positive. If it is favorable, it's a positive, right? So if we solve for budgeted hours, or if we make budgeted hours subject to the formula, we are going to then arrive at this amount, that is 1,580 hours as our answer. Are we together, ladies and gentlemen? Good. Okay, you can use the additional information there to edify the information I have already given you. All right, you can pause the video and read through. All right, the information is very important again. Can you make use of it? Now, time series analysis using the multiplicative model. When using the multiplicative model, always ensure your seasonal variations multiply to the annual average. This helps in accurately predicting patterns and trends in your data. It's like having a well-tuned instrument. The harmony is in the balance. All right, so there is this other information which you might as well need. Okay, you might need this information. It's very, very essential, but it wasn't part of the, our problems or our questions, right? But it's very essential. Okay, generally, if you're talking of the additive model, right, we are looking at the absolute amount or when it comes to the expression of or the presentation of a seasonal variation, right? So we are looking at absolute amount being added to a trend to find the actual result, right? For example, ice cream sales in summer are expected to be 200,000 above the trend. So if we are making a forecast using the additive model, we are going to say forecast is equal to trend plus the seasonal variation. However, if you are looking at the multiplicative model, the data is normally in percentages or it's a proportion, right? So we normally, when making a forecast, will be then saying trend multiplied by the seasonal variation. All right, so that particular example can be found from the ACCA Kaplan text, the MA text. You can use this particular example to edify what I'm trying to say. However, we are having, okay, this information, like I said, can be found from the ACCA Kaplan text, right? But I'm fearing that, the video is gonna be long and not going to be beneficial, especially to those who have done the mock. All right, so let us just discuss the question that is linked to the mock examination. In a time series analysis, the multiplicative model is used to forecast sales and the following seasonal variation apply. Remember, instead of summing to zero, as with the additive approach, the averages should sum, in this case, to 4. Okay, 1 for each of the 4 quarters. All right, we are given the information of each quarter. All right, the information of quarters. We have got quarter 1, quarter 2, quarter 3, quarter 4 in a year. However, what we should as well know is that we have got 4 quarters in a year. Four quarters in a year. This is going to help us if you are about to solve the question, as in this case, we are required to determine the seasonal variation in the 4th quarter. But how are we going to get that? That's when we have to lead ourselves, right? We need to lead ourselves. All right. So the easiest way, some people prefer to use equations, all right? Equations could be useful, all right? For example, we can say, let year 4 seasonal variation be X, all right? Let year 4 quarter 4 seasonal variation should be X. So the equation would become 0.45, which is for the first quarter, plus 1.22, this one, that is for second quarter, plus 1.31 for the third quarter, plus fourth quarter should or equal to 4. Are we together? So in this case, x is equal to, if we solve, we can, if we add 0.45 plus 1.22 plus 1.31, let me use my calculator, 0.45 plus 1.22 plus 1.31, we get 298. All right, so we then say 4 minus 2.98, because we have taken these figures to the other side of the equation. The total is 2.98, so we have to subtract it on that side. So this comes to x is equal to 1.02. All right, so that was our seasonal variation for quarter 4. Are we together? All right. The easiest way, again, which we could have used without going to the long equation route, was simply to just add these figures. Okay, we add them. We should have added these 3 figures first, and we get our 2.98. And knowing that we have got 4 quarters, therefore the seasonal variation should add to 4. So we determine the difference, which was going to be 1.02. That was going to be very quicker, especially if we are under time constraints. Remember, here your workings are not going to be shown in this particular examination, so you need to move. You need to be up the beat. You need to move. You need to be on fire. You need to be on fire. You need to run. Now comes absorption and marginal costing. Absorption and marginal costing. Okay, now we are at another tricky question. All right. A company calculates the following under a standard absorption costing system: the sales volume margin variance, the total fixed overhead variance, and the total variable overhead variance. If a company changed to a standard marginal costing system, which variances could change in value? So we are being tested on your understanding of variances further. All right. Now, before I discuss about the nitty-gritties of these variances, I want you to appreciate that this variance has got another name. Okay. Sometimes instead of using the word margin, they talk of profit. Sales volume profit variance. All right. But the reason why they have put margin, they want you to understand that this type of profit sometimes is contribution. Okay. In marginal costing, we'll be talking of contribution, but in absorption costing, we'll be talking of profit. So the safest way to use is margin, because margin gives us enough headroom to exercise, because it is applicable in the marginal costing as well as the absorption costing context. All right. That said, I think we need then to get into answering the question. Sales volume margin variance. This variance is affected because absorption costing includes fixed costs in product costs, while marginal costing doesn't. But I want you to also understand that when we talk of volume, we are really talking of quantities which were sold, if it is a sales variance. But if we are talking of material variance, then we'll be talking of actual output. We'll be talking of, output. But in this case, we are talking of the quantities which were sold. So sales volume margin variance is likely going to change if we shift from absorption costing to marginal costing. Why? Because when we were computing the variance, we had, or when we were costing the products which were sold, we were including fixed costs in the product. But now, if we move to marginal costing, we won't be including those costs in the cost of the product. Therefore, we expect this variance to change. In that case, the variance is going to change. Then, when for the total fixed overhead variance, this variance changes because absorption costing absorbs fixed overheads into product cost, while marginal costing doesn't. When you switch to marginal costing, the fixed overhead variance will be calculated differently. So again, this is going to change. So this variance is also going to change. So the question is saying which of these are going to have some changes. So this one again is also going to change. So the first two are going to change. What about the third one? The total variable overhead variance. This variance doesn't change because both absorption costing and marginal costing account for variable overheads in the same way. Calculation for variable overhead variance remains the same regardless of the costing method. Right, so how we are going to account for the variable costs, the variable overheads is just going to be the same whether we are doing our costing in the absorption costing context or the marginal costing. All right. In a standard absorption costing system, the sales volume margin variance is based upon profit per unit, whereas under marginal costing, it is based upon contribution per unit. I've spoken about this. Okay, in absorption costing, we are talking of the profit per unit, but in marginal costing, we are talking of contribution per unit. So just have to be careful about that margin. In a standard absorption costing system, the total fixed overhead variance includes expenditure and volume variances. All right, so the total fixed overhead variance has got two sub variances under it, which are the expenditure variance and the volume variance. Under marginal costing, only the expenditure variance is included variable. So we are given more information as to why there are going to be some changes. Under marginal costing, only the expenditure variance included. Variable cost variances are the same under both systems. We've spoken about this. So let us maybe make our argument using formulae. So because we need to know the formulas behind these variances so that we make our case audible. In absorption costing, so let's start with the sales volume margin variance. If it is in an absorption costing environment, the sales volume margin variance is found by the actual sales minus budgeted sales multiplied by standard contribution margin per unit. Okay, this is why I said here, this is the standard profit. We are talking of profit, not contribution. Right? We are talking of standard profit. Are we together, ladies and gentlemen? All right, it's the standard profit. However, when you use the standard contribution margin, you then have to add the fixed overhead per unit. right, which is the overhead absorption rate usually, right? So you can see that, let me try to repound this. I'm having a problem. Okay, right, because I'm not finding my pen. Yes, I was no longer finding my pen. All right, good. So if you do not input the standard profit, you then have to ensure that you add the standard contribution margin per unit plus the fixed overhead uh, cost per unit. All right, that makes up. I mean, yes, that makes uh, the standard profit, right? That combination will come up to the standard profit, or it makes up the standard profit. All right, so that's the formula in an absorption costing context. Now, if we move to the marginal costing environment, the formula becomes actual sales minus budgeted sales multiplied by the standard contribution margin per unit. So you can see that the formula have changed. So in that case, the margin is going to change. The formulas will be different. So in that case, there is going to be a change. What about the total fixed overhead variance? In an absorption costing environment, this variance is equal to actual fixed overhead minus the budgeted fixed overhead, right? Budgeted fixed overhead multiplied by actual output over budgeted output. In this case, this bracket is representing a flexed cost. Okay, it will be a flexed cost. Remember, fixed overhead total variance is the difference between the actual fixed production overheads incurred during a period and the flexed cost, that is fixed overhead absorbed. Flexed cost. All right, now if we move to the marginal cost, the variance will be actual fixed overhead minus budgeted fixed overhead, and we are done. So you can see that in that case, the results are going to change. The values are going to change. So the variance is going to change as well. Lastly, the total variable overhead variance. Under the absorption costing environment, this variance is equal to actual variable overhead minus standard variable overhead rate multiplied by the output. And similarly, under the marginal costing, we'll be having the same figures. So this one does not change. I'm sure we are done. Okay, please revisit your textbooks for you to appreciate these in detail. Wow. Question 7. Congo Company operates a bottling plant. The liquid content of a filled bottle of product X is 2 liters. During the filling process, there is a 30% loss of liquid input due to spillage and evaporation. The standard price of the liquid is $20 per liter. The standard cost of the liquid per bottle of product X to the nearest cent is. Now, there is a tip I have written there. When dealing with problems involving waste or loss, remember to divide the required output by 1 minus loss percentage. To find the total input required, this ensures you account for the loss and calculate the correct total input. So In this case, we are told that there is always going to be a 30% loss of liquid input due to spillage and evaporation. Right? However, each bottle requires about 2 liters, right, of the liquid. So in this case, how many liters do we need? Obviously, we need something like 2 over 1 minus the loss. The loss in this case, that's 30%. Okay, so this should be, all right, so that's 2 over 1 point, it becomes 2 over 0.7. 2 over 0.7. This should take us to how many liters per unit? Because each unit requires 2 liters, but if we only input 2 liters, or if we only budget for 2 liters alone, it means that we will not be able to meet the quantities we want. So we need to ensure that we budget with an extra liquid. So in this case, 2 over 70%, how much do we get? 2 over 0.7. That's, we need 2.86 liters. That's our budget, isn't it? Yes, we need 2.8 liters. All right, then let us calculate the standard cost of the liquid per bottle. So the standard cost is equal to the total liquid input per bottle, which we have discovered, or which we have determined as 2.86 liters, multiplied by the standard price. And we were told in the question that the standard price is 1.2. So the standard cost should be 2.86 liters multiplied by the standard cost per bottle. That is 1.2. I mean $0.20, right? So this means that our cost will come to $3.43 per bottle. It's very easy, isn't it? Yeah, very, very easy. Okay. Better. Now, at an output level of 10,000 units, a company budgets for fixed production costs of $2,000 and variable production costs of $5,000. In period 1, when actual production was 11,000 units, the total production cost was 8,000. The company uses flexed budget for comparison purposes. What was the total production cost variance for period 1? Now, we then have, okay, we can just ignore this, all right, it's a typo, right? Let us just ignore that one. Now, let's concentrate. To find the total production cost variance for period 1, first of all, we need to calculate the budgeted fixed production cost per period. So budgeted fixed production costs were equal to 2,000. All right, we are told in the question that the budgeted fixed production costs were $2,000. Now let's calculate the budgeted variable production cost per unit. Budgeted variable production cost per unit is equal to budgeted variable production cost divided by the budgeted output, right? Remember, this is an overhead absorption rate, budgeted cost over budgeted quantity, right? So that's the budgeted production cost for us. So in this case, we are told that the budgeted production cost was 5,000, right? and variable production cost of 5,000. All right. Whereas the budgeted output was 10,000. Okay. So in this case, this can't be an overhead absorption rate. I'm sorry for that, because normally, but it just gives it the same concept, but usually the OAR is on fixed overhead absorption rate. It actually should be linked to fixed costs. All right, so it's not proper to use it in the variable costing environment. So, but the concept of that's the same. So, we were budgeting to have variable overheads of 5,000 for quantities of 10,000 units. So, which means each unit was costing $50. All right, that should be the answer for now. Then what we then need to do is to calculate the flexed budget for 11,000 units. Remember, flexed budgets adjust themselves, or they adjust in a relation or in response to the actual activity. All right, so according to our initial plan, we were aiming a production level of 10,000 units. All right, according to the question, the production was at 10,000 units. However, the actual figures now are telling us that we have produced 11,000. So at 11,000 units, what would become of our costs? What would become of our cost? All right, so we also appreciate that the fixed costs are not going to change in relation to the changes in activity. Okay, so fixed costs in total, they remain constant. So those ones will come as they are. We put our 2,000. However, now we expect that the variable costs are going to flex, are going to change in relation to the actual activity. So in this case, we now have 11,000 units multiplied by the variable cost per unit. So we are going to arrive at a total cost of 7,500. Now, let's calculate the total production cost variance. In this case, the total production cost variance is going to be the actual total production cost minus the flexed budget. We want to see if the actual production cost is going to be higher or lower than the flexed budget. All right, so the question tells us that the actual cost of production was 8,000. However, we now have a flexed budget of 7,500. So 8,000 minus 7,500 is going to give us 500 adverse. Why? This is because the actual cost of 8,000 is larger than the flexed budget of 7,500. So this is why we are having an adverse variance of $500 in period 1. Am I heard? Thank you. If you hear me, if you heard me, thank you. Okay, you can as well understand these figures using some table, right? So this was our original budget. All right, we were planning to produce 10,000 units, and our fixed cost according to the initial plan were 2,000, and the variable cost was 5,000. This was according to the plan, right? We saw it, all right? But now we expect that in a flexed budget, only variable costs are going to change in relation to the activity. So the fixed costs are going to come as they are, However, these ones are going to be flexed, the variable cost. Why? Because they change in relation to activity. So we are forced to first determine the variable cost per unit, and then we multiply that by the actual quantities, the 11,000. So the variable cost per unit in terms of the budget were the 5,000 divided by the 10,000 units. So this took us to 0.5. So we then have to multiply this by the 11,000 actual units, and we should come to 5,500. This is the 5,500 we are talking about. If we add them up, we arrive at 7,500. Okay, then we're also told that the actual cost of these 11,000 units was 8,000. So it means that the actual are larger than the flexed budget. So we are going to arrive at 500 adverse. So simple, isn't it? Great. Please take the notes. Otherwise, you're going to fail this examination. For those who want to contact me, please feel free to app or call me at +263 774 596 368. It's a Zimbabwean number. Proudly Zimbabwe. Let's move on. All this information is very vital for you. Please use it. Question number 9. For each company's actual contribution for the last accounting period was 120,000. The following variances have been calculated. You've got the sales volume contribution variance, 15,000, adverse sales price variance, 13,000, favorable fixed overhead expenditure variance, 7,000, favorable total direct materials variance, 11,000, adverse total direct labor variance, 4,000, favorable total variable overhead variance, 3,000, adverse. What was the standard contribution for actual sales in the last accounting period? Just type in the figure, ignoring the dollar sign and any comma. Ladies and gentlemen, in the examination, there are questions which are going to require you to type in the figures yourself. You're not going to be given the multiple choice. So you need then to just follow the instructions. If the question says don't put any dollar sign, just put the figure. The dollar sign has been put for you by the examiner, so don't worry about it. You just have to follow the instruction. Otherwise, you will fail because of that simple error. That simple mistake is going to cost you. So you need to pay very careful attention. All right. Now you also need to understand that we are talking of the standard contribution for actual sales. That should give you some signal that we are in a marginal costing environment, something like that. Okay, we are talking of the marginal costing environment. Contribution. We are talking of some marginal costing environment. Okay. Okay. Now, to answer this question, it is useful to consider a layout of the operating statement, right? This is an operating statement that is normally going to be found, right, in a marginal costing environment. All right, so we're going to start with the standard budgeted contribution, and then the sales contribution variance, the standard contribution for actual sales, at the sales price variance, total cost variance, and we'll come to the actual contribution. So you need to use this, right, and add in the figures given in the question. So obviously, first, the standard budgeted contribution. The standard budgeted contribution, was it given? We were not given that, all right? So we just have to ignore, and then we'll move on All right. Okay, so if we know the template, then we are good to go. One thing I'm happy about this question is that we are given this figure, all right? This figure, ladies and gentlemen, has been given to us, okay? Because we are told that the actual, right? The actual contribution was 120,000. So we can then, first of all, slot in that figure, right? And then, of course, we're not given the standard budgeted contribution. It doesn't matter because normally we don't need it. The figure we need to calculate is this one. So this one we don't need. We don't need that one. All right, don't need it for now. We can as well, if we don't have the top information, we can then start from the figure which we have going up, right, until we arrive at this particular figure which we need the X there. All right, the template talks of the sales contribution variance. Do we need it? We don't need it again because well, if we knew this figure, if we had that figure, then we were going to need this one. But because we don't have this one, therefore this figure is not going to help us. All right. So these are the two. Those figures are not relevant to us. So what we need is the information below this particular X. Okay, the information below the X. All right. So now let's then slot in let us find out if do we have the sales price variance from the information? Sales price variance, yes, it's a favorable 13,000. Then on a cost variances, we have got the total direct materials variance of 11,000. So this is the figure we are talking about. All right. Like I said, this is a, it is a, what can I do? It's a marginal costing issue. So if it is a marginal costing issue, to arrive at contribution, do we need fixed costs to arrive at the total contribution? I mean, the actual contribution or the standard contribution. Obviously, we don't need this. This one is not needed. It's not needed. All right. It was a red herring. It was some trap for you. If you're not prepared, you are going to be found unawares. So we ignore that one. They are irrelevant for us. Then, so we have spoken of this one. And the direct material variance was adverse. If it was adverse, okay, direct material variance. Where is it? Direct materials. Okay, it's adverse. We have already ticked it. The direct labor variance, 4,000 favorable. Was it slotted in? Yes, 4,000 favorable. And then we come back again and say total variable overhead variance. We have to input it here. Now, because we are starting from the bottom up, we then have to be very, very careful there. The actual contribution, for us to arrive at the to arrive to this standard contribution, we are starting from the actual contribution of 120. So what we do is we say 120,000. Remember, we are in thousand. 120,000. The adverse, remember, adverse are negatives. These ones are negatives. Okay, and the favorables are positives by nature. But now, for us to come to the standard contribution, we're going to do the opposite now. We're going to add the negatives, add 3,000, okay, less 4, add 11,000 less 13. They are in thousands. So we're going to come to, let me use my calculator there, 120 plus 3 minus 4 plus 11 minus 13. We arrive at 117,000. So that one was the standard contribution, right? So all in all, the overall variance, if the question could have even asked, what is the overall variance on this? If the standard contribution was 170 versus the actual contribution of 120, obviously we are having a favorable variance. Why? Because the actual contribution is larger than the standard or the budgeted contribution. You may as well use these notes if you want them. Okay, let's move on to this. Now let's talk of value analysis. It's also part of our syllabus. Value analysis. Remember, exchange value refers to the price or monetary value that customers place on product, while use value refers to the functional benefit or utility that a product provides. So value analysis is a concept that is linked to the reason why people buy products. So if you're a business and you want to offer goods to the market, you need to ask yourself, how is my product perceived by the market? What type of benefit is it going to bring to a customer? All right, so that's the idea behind value analysis. So the management accountant of a desk manufacturer is in the process of preparing a value analysis. Two features of one desk sold by the manufacturer are sales price and number two, can be attached to other units to increase desk size. Right? So you can see that here the first one talks of the monetary benefit or the price issues, whereas or monetary or cost issues, whereas here we are talking of the functionality, how the desk is going to be used. Sometimes customers value the portability of the issue, or maybe the functions attached to there. Sometimes it offers some extra drawers and so forth. That's the functionality of the desk. So there are many value attributes that could be found, right? We can talk of exchange value, right? Maybe customers see it as cheaper, right? And that's something that is related to the price or monetary value. Then we might look at the product in terms of its functional benefits or use value. Functional benefits or use value. So obviously, because the question is saying what is the correct value analysis classification for each feature. So the first feature there is talking of exchange value. When you talk of the sales price of $100 or $150, we are talking of the exchange value. We're not talking of the exchange rate. Remember, the question, the answers there, the exchange rate value, those ones, exchange rate was out of question. Okay, exchange rate is out of question. It was put on there to just trap you. Okay, some people, when they see the word exchange, they just rush through and they don't then read the other words which are attached to the word. So that is going to be very catastrophic. So exchange value is about the prices and so forth, or the monetary values attached. Then the attributes like if the desk is going to be used to increase space, that's the functionality of the product, and that one is linked to what is called use value. All right, so that's use value. All right, so these are the notes you may refer to. The notes also takes you deeper into the other attributes or other classifications of value. All right, we have got exchange value. All right, we've spoken about this exchange value. Sometimes the customers value what is called esteem. Some people value things. In terms of snobbishness. Some things offer what are called snobbish benefits. Snobbish. There are people who don't buy things just because they are cheaper. They don't buy them. All right, they want to bling, right? Okay, something that brings some some esteem value. All right, so it is related to status or prestige. All right, so esteem value, some people consider it. The cost value is the actual cost of producing the product or providing the service, the actual cost. Then exchange rate, this one I said this is related to currencies and so forth. All right, but it doesn't relate to value analysis. So if you find it as part of the option, please ignore it. Then use value. This one is very relevant. Sorry, this one is relevant. It's relevant. So in this question, the sales price of 149 is the exchange value. The functionality of the desk allowing them to reconfigure to suit each customer is the use value. So we are done. Let's talk of question 11. Question 11. Innova Manufacturing Limited has recorded the following monthly maintenance costs. Production volume 1,500 units, total maintenance cost 4,000. Then 2,500 units, 7,000. Company employs one maintenance supervisor for every 2,000 units of production. Each supervisor earns $1,000 per month. The budgeted production volume for month 8 is 3,250 units. What is the budgeted maintenance cost for 8,000? For month 8? And the instruction that you just have to input a figure in that order. No commas, nothing. If you put a comma, you are going to get a 0. Why? Because you did not follow the instruction, and the computer is just going to reject your answer and give you a 0. Follow instructions. All right. A lot of people were using the high-low method in attempting this question. Yes, you were trying to come up with the idea, but you were supposed to have done some adjustments to the figures before you just jump into that. All right, so this was the solution, ladies and gentlemen. You were supposed to be very, very systematic. Now, in any budgeting question such as this, the first step is to identify the cost behavior which is being exhibited. The costs given are clearly not fixed costs, as they are different at the two different volume levels. To establish if they are variable costs, calculate the unit cost at each level of volume. So we need to compute the unit cost at each level. The complication here is that there is a supervisor cost of 1,000 included at a volume of 1,500 units. Why? Because if we look at this, right, you need also to ensure that the cost of the supervisor is taken care of. All right. The company employs one maintenance supervisor for every 2,000 units of production. Each supervisor earns $1,000 per month. So sorry. So the supervisor is actually at this corner. So not all right. The communication here is that there is a supervisor cost of $1,000 at the volume of 1,500 units and 2,000 included at a volume of 2,500. This should be taken out before calculating the unit cost. Okay. Okay. I faced some mix-up somehow. Okay. Now, this particular company employs a maintenance supervisor, okay, for every 2,000 units of production, and the supervisor will be earning 1,000. So at this level, we are having one supervisor, right? We'll be having a supervisor, and then if we reach this particular level, it means that there will be two supervisors, all right? If we are producing at 1,500, we would need only one supervisor. Why? Because we haven't reached the 2,000 threshold, 2,000 unit threshold. But if we reached the 2,000, beyond the 2,000, we would need an additional supervisor. So if the production is less than 2,000, we are just going to need one supervisor. But if it goes beyond 2,000, like for example, if the production is 3,500, we would be needing two supervisors. If it comes to 4,500, it means that we would now need three supervisors, something like that. All right. Now, so you were supposed to determine to adjust the figures relevant. We know that supervisors are not a variable cost. Okay, they are not a variable cost because they are not directly linked. They're not a direct cost. They're not directly linked to production. So their costs are likely to be fixed and so forth. So we remove them. If we are now computing the variable cost per unit, we need to remove them, something like that. So this is why I say that you were supposed to have done your adjustments before you just jump into high-low method. Right? So the unit cost at a volume of 1,500, as can be seen, maybe the black pen is visible. All right. So at 1,500, the cost per unit or the variable cost per unit should come to $2, right? After we remove the cost of the supervisor, all right? But now, if the production comes to 2,500, the cost of the supervisors is going to come to 2,000. You need to remove the 2,000 from the 7,000 there, and you should come to $2. These figures are being constant. Remember, the graph of variable cost per unit is a constant. Okay, it does not change in terms of level of activity. The costs do not change. If it is a variable cost per unit, the costs are going to be constant per unit. All right, but variable costs in total, they do change in terms of the level of activity. Bear that in mind. The graph for variable cost per unit is just the same as the graph for fixed costs in total. All right, the fixed costs in total, they do not change in relation to the level of activity. Similarly, the variable cost per unit. All right, so that's the technicality. Now, can we were we supposed to use the high-low method? If we had used the high-low method, were we going to arrive at the $2 per unit? Yes, provided you did the adjustments for those, the relevant adjustments, right? The relevant adjustments were necessary. So, for example, here, the cost should have been adjusted accordingly. For example, at 1,500, the cost should be 3,000. That is 4,000 minus 1,000, 3,000. All right, and this should be the lower cost, and the higher cost should be 7,000 minus 2,000 to be 5,000. All right, and then these ones would leave them as they are, the quantities. So if we use the high-low, it comes to the higher cost 5,000 minus the lower cost over the higher quantity 2.5 minus the lower quantity 1.5. So on top we're going to be left with $2,000. Below we're going to come to $1,000, and you will see that the variable cost per unit was going to be $2. So what you needed was just to first adjust those figures and come up with the correct variable cost per unit. Now that if we now know the variable cost per unit, so we then have to calculate the total variable costs, right? So at the level of 3,250 units, the variable cost per unit become 6,500. Okay, that's the units multiplied by the variable cost per unit of $2. Then the supervisor costs are going to be considered as well, so that we arrive at the total maintenance costs. Remember, I said that the supervisor costs are likely to be fixed. So in this case, because at this level, at 3,250, we need 2 supervisors. So this is why I say 2 multiplied by the cost per supervisor of, the salary of the supervisor, $1,000. So they come to 2,000. So if we add 6,500 plus 2,000, we are going to arrive at $8,500. Is that clear? I'm sure it is. All right. Now there was a section B question. This one we are not going to dwell much on it, because I know that it is now a repetition. It was a long variance question, and you guys are supposed to be tired by now, but I think it's worth our attempt. So let's do it. I think we must give ourselves just 5 minutes to do the question. Light Company manufactures bulbs. The following figures are available. 500 kgs of direct materials were actually purchased. So these were the actual purchases, the quantities which were actually purchased. All right, let me find a better pen color. Then the standard cost per kilo is $2.25. Is that figure too? The figure is too clear? I think it's no longer clear. Right, so that's $2.25, leading to a standard cost of actual purchases of that much. Standard cost of actual purchases. All right, there is some little bit of flexing there, right? It's the actual purchases flexed with the variable cost per unit, with the standard cost per unit of $2.25, which arrives to, so there is some actual, the actual quantities leading multiply by the budgeted price. Actual quantity multiply by the budgeted price or the standard cost. Let me try to verify that if I'm correct. 500 kgs multiplied by 225. How much do we get there? 500 multiplied by 225. Yes, we get $1,125. Okay, we flexed the actual purchases with the standard price. Okay, now we're also told that the direct material price variance is 125 favorable. If the price variance is $125 favorable, it means that we bought our quantities cheaper. So if they had costed us 1,125, but it's 125 favorable, it means, what does this mean? It means the actual price or the actual cost, actual price was supposed to be 1125 minus the variance favorable VAR of 125. It means the actual price was 1,000 because it was favorable. We bought this, they were cheaper, the materials were cheaper. Okay, we are saying if the actual price for the quantities for the purchases, the actual price for the purchase, if the standard price of the actual purchases, standard price of the actual purchase was 1,125, and this triggered a favorable balance, a favorable variance of 125. This means that they were cheaper. We paid less, right? We paid less by how much? By 125, all right? So, which means the actual price was $1,000. So obviously, just by using that reasoning, we have attempted the part one of the question. Okay, calculate the actual price paid, and we've determined the actual price, isn't it? Very simple. So you need not to read these things like you're following a storybook. No, it doesn't work like that. When you be reading, you then have to be reasoning. You must be reasoning. Otherwise, you won't finish the examination. Okay, I've deleted everything there so that my board becomes smarter. All right, you guys will be seeing these things. All right, let's move on. Now we are told that the direct materials usage variance is $45 adverse. Now this isn't worrying. If we are having a usage variance that is negative, we should be worried. Right? It means maybe we have used more materials and or something like that. All right, so we want to be very, very happy. Okay, guys, I'm a little bit worried. Okay, we didn't actually attended to this. Well, at least we discovered or we determined the um, price which was paid in total, right? The 1,000 which we discovered, 1,000 as the actual price paid for the 500 kgs. We didn't find out the price paid per kilo. So, but this one is very simple. Okay, per kilo is simply means 1,000 divided by 500 kgs, and we get the amount as $2 per kg. So you can as well see that $2 is lower than the standard cost of $2.25. So we are as well justified to say that we were in a favorable position. Right now, when it comes to the usage variance, this is when I said we were not happy. Okay. If we are having an adverse usage variance, it means that maybe we used more materials, all right? But by how much? By how much? This is very simple, all right? To get how much, we know that the standard cost of the material, let me just erase the board to make it clean. We know that the standard cost per kg is $2.25 and the adverse was for $45. So this means that the adverse is linked to these kgs, 45, the variance, divided by the cost, the standard cost of $2.25. So the dollar signs are going to cancel each other, that's obvious. So 45 divided by 225, this should give us 20 kgs. All right, so the 20 kgs are the shortfall or the materials which were used beyond the budget. All right, but that's not the answer, remember, okay? The question is saying calculate the standard quantity that should have been used for actual production. All right. We are not told of the actual output from the question. All right. We don't have that information. So we can make some assumptions. We don't have the information of the actual output, neither do we have the information of the actual quantities which were used. We don't have that information. So we need to make an assumption that the 500 which were the 500 kgs were actually used up. Okay, were bought and used. That's the idea, right? That's the idea we have for the moment. Okay, if we look at these notes, you can see that a lot of assumptions are at play. Okay, we just have to assume that the 500 kgs which were bought were used up. All right, however, for us to arrive at the standard quantity that should have been used, we then have to make sure that we use the actual quantity purchased, all right, and then we add or subtract with the variance which we have. And in this case, we have got a negative variance. All right. We then have to then lessen because it's a shortfall. Right. The shortfall is a negative. So in that case, we say this should be a minus sign there. All right. So as you can see here, the actual quantity minus the shortfall. All right, and the actual quantity of 50 kgs minus the variance quantity, which we which we determined by saying 45, which was the adverse variance, divided by the standard cost of $2.25, and we got the 20 kg. So that's, we need to lessen that, and we get our 480 kgs. This was the quantity that was supposed to have been used for the actual production. However, we did not use 408 kgs, but instead we used 500 kgs, which was the reason why we ended up having an adverse. We used more, right? Instead of using 480 kgs, we then ended up using 500, which was more altogether, and we ended up having a negative variance. It's okay. I think the point has been had, and you guys can make use of these notes as you prepare yourselves for the this papers. This examination. All right. Which of the following is likely to lead to the variances stated above? All right. Remember, we were having a favorable variance in terms of prices, right? The prices, material price was favorable, but usage was adverse, right? So material prices could be favorable, maybe because they were cheaper, and because they were cheaper, there is a risk that they could be of lower quality. All right, so lower quality direct materials have been purchased. It's favorable monetary wise, but in terms of quality, we're going to be risking something, because this was then explained by the adverse in terms of usage. So the usage, sorry, the usage variance negative. It means that we might have purchased materials which were of substandard, and this means that we ended up using more materials in our manufacturing process, right? So I can safely say that our answer should actually be 1. This is the answer. This other one, we purchased high quality direct materials. This one cannot be supported, because if they were high quality, they were likely going to be very expensive, and we were likely going to save, instead of having an adverse usage variance, we're supposed to be having a favorable usage variance, because usually high quality materials are going to be used in smaller quantities, not heavy quantities or bigger quantities, as we did. All right. Are we together? Good. Okay. We are having that question. The following graph shows the standard price and quantity, and the actual and price and quantity relating to the direct material for the manufacture of the bulbs. Okay. So that's the graph we are having there. Required, which area correctly represents the direct material price variance? Do we know the formula for this? We have been speaking of variances. Okay, the material price variance should be actual price minus standard price multiplied by actual quantity. Okay, so knowing that in mind, you then have to say, all right, on the graph, which points are actually speaking to this formula? We've got the actual price there, the standard price there, right? We've got the actual quantity there. Okay. But the variance itself is the difference between the actual price and the standard price. So obviously, our answer should be within these points. Okay? But which ones exactly? Which points exactly? You can pause the video and attempt the question. So since this is the difference between actual price and standard price, therefore the area we need should be this one. This is the variance. So if that's the area, it means we need point AP, WZ, this is the W and this is the Z, okay, WZ, and the selling price SP. So you can see that this is the area we are talking about. Is that clear, ladies and gentlemen? Okay, so that's the idea. Do we still have other questions? Okay, spreadsheets. So this question was also linked to spreadsheets. So I think the part D. All right, the following spreadsheet has started to be completed for direct materials with a tick, okay, a tick showing where data has been entered. Okay, for example, production in units have been entered here. That is for the standard production in units, the standard units for the production have been entered there, whereas the actual units have been entered there. Similarly, the kgs per unit there, the cost per kilo there, and the actual cost per kilo there. Then the total kilograms purchased, these ones, the actual have been entered there, right? But there is this particular formula inside there, C6, 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 C6 is actually this one, all right? It's talking of total material cost, all right? C6 over C4, the C4 is cost per kg, all right? So this gives us actually, so this one is the total kgs purchased. Total kgs purchased. We get that one using the total material cost divided by the cost per kgs, and we get the quantities. All right. Now the question is saying, what will be the formula for materials usage variance? Materials usage variance. All right. Materials usage variance usually is actual quantity minus standard quantity multiplied by standard price. All right, but this standard quantity, please be careful, it's standard quantity of actual production. Standard quantity of actual production. Similarly, the actual quantity, these are the actual quantities used in the actual production. Actual quantities of materials used in production. Then the standard quantities of materials to produce the actual results. Okay, standard quantities of actual production. Be careful there. You need to be aware of that. All right. Okay, so having that in mind, it is obvious that we then have to slot. Remember, this is a spreadsheet, and I'm sure you know of these. Rows and columns and cells, all those things, right? So for us to determine the actual quantity used in the production, obviously we need to pick the cells which are going to offer that. So obviously the cell C5, this one, this cell is very important, but it gives us the total quantities purchased. So because we are not told of the actual quantities used in the production, so we can just assume that those quantities which were purchased were actually used in the production. So this is why I'm saying, so cell C5, this particular cell is very important. So C5 multiplied by the standard price. Okay, multiplied by the standard price, because we need to multiply the actual quantity multiplied by the standard price. Okay, and the standard price is this one. So you can see that we need C5 multiplied by B4. So obviously our answers by elimination, our answers should be between B and C first. All right, B and C, because those are the ones that have got the C5 multiplied by B4. Are we together? Please pause the video and understand. Okay. Then the other part now, the standard quantity for actual production. The standard quantity for actual production, right? This one now talks of the, we need to know the units which were produced. Okay, we need to know the units produced. Units produced, these ones are going to be found in, because we are saying it's standard quantity of actual production. So we want the actual production. So production information is given there in that line, that row. So the actual production is C2, all right, is C2. So obviously B has been eliminated. B has been eliminated, and in the examination you can safely pick D without wasting much of your time. But anyway, let us finish. So we say the actual production was C2, the figure in C2. Then we multiply by the kgs required per unit. How much is how many kgs are required to manufacture 1 unit? And these kgs should be standard kgs or budgeted kgs per unit. So the standard kgs are found in B3. Then multiply, of course, by the cost per kg, which is also going to be found in B4. It should be standard cost multiplied by standard kgs multiplied by the actual quantities. All right. So be careful. The SQ there, the standard quantity, is actually the standard quantity of actual production. All right. This is what I've summarized. The units produced multiplied by the standard quantity multiplied by the standard price. That's the SQ. The SQ. Be careful. That SQ. Be careful. And the AQ is actually this actual quantity used multiply. Okay, the SP is actually common because we are saying it's actual quantity minus standard quantity multiplied by the standard price. So standard price is actually going to multiply with this one and with that one. So it's in both of those. So this is why we are having the SP here, but it is also there. It is multiplying the actual quantity as well as the standard quantity. Right, but I wanted to point out that because it's a usage variance, the actual quantity should be the actual quantity used in production. Are we together, ladies and gentlemen? Better. So I think we are done. All right, you can as well read this particular question and the answer is there just to correct your positions. All right, pause the video and you can as well use the facts as shown on the screen. There is also this one, out of interest, the material price variance, again just for your revision. All right, and I think we can give ourselves a very, very big good luck. All right, let's give ourselves a very, very big good luck. All right, so ladies and gentlemen, these are my numbers. You can app me, WhatsApp me, or even call anytime, any day. I will always wait for your calls. You are special people for me. Are we together, ladies and gentlemen? Thank you. Please feel excited. I mean it. Very, very excited. Goodbye.